Taxes. Nobody likes them, especially when they eat into your hard-earned investment gains. But what if there was a way to keep Uncle Sam at bay? Have you ever wondered why some investments seem to put more money in your pocket than others? It's not just about choosing the hottest stocks or funds. Sometimes it's about minimizing what you lose to taxes. That's where ETFs, or exchange-traded funds, come into play. ETFs have become incredibly popular among investors, not just for their low costs and flexibility, but also for their impressive tax efficiency. If you're looking to keep more of your returns rather than handing them over to the taxman, understanding how ETFs work can be a game changer. In this video, we'll break down exactly why ETFs are often the go-to choice for tax-savvy investors. We'll explore how you can use them to maximize your portfolio's growth, minimize taxes, and keep your investments running smoothly. This guide will help you get more out of every dollar you invest. Let's dive in. Chapter 1. What makes ETFs tax efficient? Let's start with a big question. What actually makes ETFs more tax efficient than other investment options? It all comes down to their unique structure. Unlike mutual funds, which have to sell securities to meet redemptions when investors cash out, ETFs operate differently. When you buy or sell ETF shares, those transactions typically happen between investors on the stock market. The ETF itself doesn't have to sell off assets to raise cash, which means fewer taxable events. But the real magic happens behind the scenes with the creation and redemption process. Instead of selling assets for cash, ETFs use an in-kind system. This allows them to exchange stocks with authorized participants without triggering capital gains. Think of it like a swap. Securities are exchanged directly, avoiding the tax hit that usually comes with selling. By using this method, ETFs can defer taxes until you decide to sell your shares. This means you have more time to let your investments grow before the tax bill comes due. It's a smart way to keep your portfolio more efficient, letting you keep more of your hard-earned gains. And who wouldn't want that? Chapter 2. The Creation and Redemption Mechanism. All right, let's dig deeper into what makes ETFs truly tax efficient. The creation and redemption process. This might sound complex, but it's actually the key to why ETFs can be so tax-friendly. Here's how it works. Unlike mutual funds that buy and sell stocks to accommodate investor inflows and outflows, ETFs use something called creation units. When demand for an ETF increases, large institutional players, known as authorized participants or APs, create new shares by delivering a basket of securities to the ETF issuer. This process is handled in kind, meaning the assets are swapped rather than sold for cash. The beauty of this system is that it allows ETFs to add or remove shares without triggering taxable events. For instance, if an AP wants to redeem shares instead of getting cash, they receive a basket of securities from the ETF. Again, no assets are sold, so there are no capital gains to distribute to shareholders. This process also gives ETFs the ability to strategically rebalance their portfolios using custom baskets. For example, if the ETF needs to adjust its holdings, it can do so by swapping specific stocks with low-cost basis, again, without incurring taxes. What's the bottom line? This unique creation and redemption mechanism means you, as an investor, are shielded from surprise tax bills that often hit mutual fund holders. It's all about keeping more of your money growing rather than paying it out in taxes. Chapter 3. Tax treatment of different types of ETFs. Not all ETFs are created equal when it comes to taxes. Understanding the differences can help you choose the most tax-efficient options for your portfolio. Let's break it down by category. Number 1. Equity ETFs. These are the most common and often the most tax-efficient. Since equity ETFs typically track an index, they rarely sell their holdings, which means minimal capital gains distributions. For you, this means less surprise tax bills at the end of the year. When you do sell your shares, if you've held them for more than a year, you're taxed at the lower long-term capital gains rate, which can be up to 20% depending on your tax bracket. Number 2. Bond ETFs. Bond ETFs distribute interest payments to shareholders, usually monthly. The catch is that this income is taxed as ordinary income, not capital gains. This can result in a higher tax bill, especially if you're in a high tax bracket. However, holding bond ETFs in a tax-deferred account like an IRA can help mitigate this issue. Number 3. Commodity ETFs. These can get a bit complicated. Many are structured as partnerships and use futures contracts, which are taxed using the 60-40 rule. 60% of gains taxed at long-term rates and 40% at short-term rates, no matter how long you've held them. Additionally, some require a K-1 form at tax time, which can be a headache to file. Number 4. Precious metals ETFs. ETFs that hold physical gold or silver are taxed as collectibles. This means any gains are taxed at a higher maximum rate of 28%, even if you've held them for over a year. It's a crucial detail to be aware of if you're considering precious metals for tax-efficient investing. Number 5. Currency ETFs. These can have varying tax treatment depending on their structure. For example, those structured as grantor trusts are taxed at ordinary income rates, while others might follow the 60-40 rule. By understanding the tax implications of each ETF type, you can strategically choose where to invest to maximize your after-tax returns. Chapter 4. Comparing ETFs versus mutual funds. Now, let's compare the tax efficiency of ETFs with their closest cousin, mutual funds. At first glance, they might seem similar, but when it comes to taxes, there are some significant differences. Mutual funds are often hit with capital gains taxes throughout the year. Here's why. Mutual fund managers frequently need to sell securities to raise cash for shareholder redemptions. When this happens, any gains from those sales are passed on to all the fund's shareholders, even if you haven't sold your shares. This means you could end up with a tax bill, even if your mutual fund lost value overall during the year. On the other hand, ETFs handle inflows and outflows through their unique creation and redemption process. Because ETF transactions are done in kind, they don't require selling assets, which helps avoid triggering taxable events. This means you're only taxed when you choose to sell your ETF shares, allowing you to control when to realize gains. But it's not all black and white. While index-based ETFs are generally tax efficient, actively managed ETFs can occasionally generate capital gains distributions. However, these are still often lower compared to actively managed mutual funds. The bottom line? For investors looking to minimize taxes, ETFs usually offer a clear advantage over mutual funds, especially if held in taxable accounts. By choosing ETFs, you can keep more control over your tax bill while still enjoying broad market exposure. Chapter 5. Leveraging ETFs for tax loss harvesting. Let's talk about a powerful tax strategy, tax loss harvesting. This technique is a smart way to reduce your tax bill, especially in a volatile market. The idea is simple. You sell investments that have lost value to offset gains you've made elsewhere, which can reduce your taxable income. Here's where ETFs really shine. Let's say you have a stock that has taken a hit this year. You can sell that stock to harvest the loss, then immediately buy an ETF that tracks a similar sector. This way, you stay invested in the market while locking in the tax benefit. The beauty of ETFs is that they're diversified, so you can replace a single stock with a broader ETF and still maintain similar exposure. One key advantage here is avoiding the wash sale rule, which prevents you from repurchasing the same or a substantially identical security within 30 days. Because ETFs are broader baskets of stocks, they don't usually fall into this category, allowing you to stay compliant while benefiting from the tax loss. This strategy can be particularly effective during market downturns, turning your losses into future tax savings. In the long run, it helps you keep more of your investment gains, boosting your overall returns. Chapter 6: Strategic Tips to Maximize Tax Efficiency with ETFs. All right, now that you understand how tax-efficient ETFs can be, let's talk about some strategic tips to make the most out of them. First, if you're investing in taxable accounts, prioritize using equity ETFs. These tend to have minimal capital gains distributions and can help reduce your annual tax liability. Since most equity ETFs passively track an index, they don't actively buy and sell stocks, which means fewer taxable events compared to actively managed funds. Next, consider holding bond ETFs in tax-advantaged accounts, like IRAs or 401ks. This is because the interest income from bond ETFs is taxed at your ordinary income rate, which can be quite high if you're in a top tax bracket. By holding them in a tax-deferred account, you can delay paying taxes until you make withdrawals, potentially saving a significant amount over the years. Additionally, always be mindful of holding periods. ETFs that pay dividends can provide qualified dividends if held for more than 60 days, which are taxed at a lower rate than regular income. So if you're looking to maximize tax efficiency, aim to hold your ETFs for the long term whenever possible. By leveraging these strategies, you can optimize your portfolio, minimize taxes, and keep more of your returns working for you. Chapter 7: Potential Pitfalls and Considerations. While ETFs are generally tax efficient, they're not entirely without potential drawbacks. It's essential to be aware of a few exceptions. Leveraged and inverse ETFs, for example, tend to be less tax efficient because they often rebalance daily, triggering frequent taxable events. Similarly, commodity ETFs that use futures contracts can complicate tax reporting due to the 60/40 tax rule and K-1 forms. Additionally, if you hold ETFs in tax-advantaged accounts, such as IRAs, remember that even though you're deferring taxes, you'll still pay ordinary income tax rates upon withdrawal, which could be higher than capital gains rates. Staying informed can help you avoid unpleasant tax surprises. So, there you have it. ETFs aren't just popular for their low costs and flexibility. They also offer significant tax advantages that can help you keep more of your hard-earned returns. By understanding how the creation and redemption process works, choosing the right types of ETFs, and leveraging tax strategies like tax loss harvesting, you can boost your portfolio's efficiency and reduce your tax bill. Remember, though, that while ETFs are generally tax efficient, it's crucial to understand the specific tax implications of the ETFs you choose. As always, consult a financial advisor for personalized advice. If you found this video helpful, don't forget to like, share, and subscribe for more insights on investing.